It's tough out there, right? Trying to keep up with everything going on with the economy. It seems like there's just a constant stream of headlines, good and bad. But, one thing you mentioned to me that really caught my attention was this whole idea of a potential recession in 2025. And I thought it'd be great to kind of take a deep dive today and really try to understand what's driving that forecast.
Yeah, absolutely. You brought some really key indicators. I think our goal today is to really connect the dots and, see if they really are signaling a potential downturn next year.
Okay. So let's lay it all out. The big question here, the core of our discussion, is this idea of a recession in 2025. And the material you gave me really highlighted a couple of important signals, the 10-2 Treasury yield spread
Right.
and the SAM recession index. And of course, we've got the data for all this from FRD, the Federal Reserve economic data.
Exactly. So we're really looking at, established economic relationships here and concrete data to help us understand this potential scenario. And we're really going to explore how these indicators point towards a possible recession in the latter half of 2025, specifically by examining the relationship between the yield spread and unemployment.
Okay, so I think a good place to start might be with the 10-2 Treasury yield spread.
Yeah, absolutely.
Now, I know not everyone listening is, super familiar with the bond markets. So to put it simply, this spread is just the difference in interest rates between U.S. Treasury bonds that mature in 10 years and those that mature in 2 years. That data, of course, is available right on FRD.
Right. And what's fascinating about this spread is the historical pattern that we see. Economists have noticed and observed over time that when the yield curve inverts, and that means that the 10-year yield actually falls below the 2-year yield, making the spread negative, it has often preceded a recession. So what that kind of reflects is this lack of confidence in the future from investors, where they're seeing weaker growth prospects down the line. So they tend to flock towards the safety of long-term bonds, which in turn drives their yields down.
I see.
Whereas the shorter-term rates are much more influenced by immediate monetary policy.
Okay. And the Recession Forecast 2025 that you share with me notes that, this inversion, this did happen. It happened in mid-2024.
Yeah.
And then the spread went back to being positive in September of 2024.
Right.
So what is the significance of that sequence of events?
Right. So that pattern of inversion followed by a return to a positive spread, or what we call normalization, has historically been a pretty reliable early indicator of an economic slowdown. And it kind of makes sense. I mean, the initial inversion suggests that there's this lack of confidence in the long-term growth prospects, right? And then the normalization that happens afterwards sometimes occurs as those short-term interest rates adjust. But the underlying concerns about the future may still persist.
Okay, so it's like this warning sign from the bond market.
Exactly.
So we've got that. Now, how does unemployment fit into all of this?
Right.
Because that's what people really feel, right? That's what really impacts their lives.
Absolutely, yeah. And that's a really key point. So based on this historical pattern that we see with the yield curve, inverting and then normalizing, the forecast that you've provided anticipates that we'll see a rise in the unemployment rate beginning around March of 2025. And of course, we can track all of this unemployment rate data on FRB. It comes directly from the Bureau of Labor Statistics. And when you see unemployment rising rapidly like that, what it signals is a broad-based contraction in economic activity, right? Businesses are basically reducing their workforce. They're responding to that decline in demand.
And this expected rise in unemployment, this is where the SAM rule recession indicator comes in, right? This is another one of the key pieces that you had highlighted.
Yeah, the SAM rule is detailed on its FRED page. It's also described in the SAM rule recession indicator methodology and 2025 forecast document. It's a really insightful way to use unemployment data to try and identify recessions early.
So what's the specific thing that we should be looking for with the SAM rule? What's the trigger?
Yeah, so the SAM rule basically signals a recession when the 3-month moving average of the national unemployment rate, that's also known as U3, increases by 0.5 percentage points or more relative to its lowest point over the preceding 12 months. So it's really looking for that significant shift upward in unemployment.
So it's not just about it being at a certain level, it's about the momentum of it increasing.
Exactly. It's the change.
Okay. So where does the SAM indicator stand right now?
So as of the latest data on FRED from February 2025, the SAM rule indicator was at 0.27. So it hasn't quite reached that critical 0.5 threshold yet.
Okay. But the Recession Forecast 2025 suggests that this is likely to change based on the projections, right?
Exactly. Right. So using those anticipated rising unemployment figures, which again are linked to the earlier yield curve activity that we talked about, the forecast projects that the SAM index will likely cross that zero point 0.5 recessionary threshold, sometime around the middle of 2025.
Okay. So if we sort of connect all these pieces, we had the yield curve inverting and then normalizing in 2024. And historically, that's been a potential signal. And then based on that historical relationship, unemployment is expected to start increasing in early 2025. And that increase in unemployment is projected to push the SAM index into recessionary territory by mid-2025, suggesting this broader economic contraction in the latter half of the year. So is that the picture we're looking at?
Yeah, I think you've summarized it really well.
Okay.
And what's particularly notable about the SAM index is that it directly uses those changes in the unemployment rate.
Right.
It uses it as an early detection mechanism.
Yeah.
It's designed to try to catch these things, these downturns, early. And of course, the Recession Forecast 2025 used those forecasted unemployment numbers to predict when that SAM rule would be triggered.
So it's like the bond market sends this initial signal based on investor sentiment, and then we see that potentially play out, materialize in the real economy through those job losses. And then that's when that SAM rule kind of gets activated.
Right. That's a great way to think about it. Yeah.
Okay.
Where that 10-2 yield spread is more of this initial market-based warning. The SAM rule then provides more of that confirmation rooted in real-world employment data. Obviously, we're focusing on these two key indicators today, but it's important to remember they're just part of a broader economic landscape.
Right. And speaking of that broader landscape, the Recession Forecast 2025 also briefly mentioned that these aren't the only indicators to watch.
Right. Absolutely. You want to have a comprehensive view. So, things like housing starts, consumer confidence surveys, and, measures of manufacturing output, all those things can offer additional insights, and they can help create a more complete understanding of what's going on in the economy to see the full picture.
Okay. So for all of you listening out there, the big takeaway here is this historical correlation that we see between the inverted and then normalizing 10-2 Treasury yield spread and then a subsequent increase in unemployment. And all that's, of course, captured by the SAM index. And what this is suggesting is a significant possibility of a recession in the second half of 2025. But it's just a forecast. It's based on these indicators. It's not a guarantee.
Right, exactly. And it's really crucial to keep in mind that we've been focused here on this one specific forecast, and it's derived from these particular indicators. But the economy is dynamic. There are a lot of different factors at play, and those things can influence, where we actually end up.
So as we're all, watching the news and reading those headlines and trying to understand what's going on with the economy in the coming months, keep this relationship, in the back of your mind between the yield curve and unemployment, because I think it really can give you a valuable perspective, on what you're seeing out there.
Yeah, absolutely. And, this all leads to a really important question for all of you to consider. Given these historical patterns that we've discussed, the timeline that we've laid out, what other kinds of economic data do you think would be especially informative to monitor in the coming months to really evaluate that likelihood of a recession, but also the potential severity of a recession? Think about how the different parts of the economy, the financial markets, labor markets, consumer behavior, all of these things interact and what clues they might give us.
So there you have it. I hope this has been helpful, and we'll all be watching to see how things unfold.
Definitely.
Thanks for joining us on this deep dive.